Hey guys, our next speaker is Mr. Eric Miller, and he is the owner CEO of Econologics. They're financial advisors that specialize in helping private practice owners. And they are my financial advisors. And I'd just like to call him out right now. Eric is responsible for me being in the financial position I'm in right now. So, and it's a good one, by the way. So Eric, with no further delays.
Okay, thank you. All right. Everyone hear me? I didn't know there was going to be a speaker challenge. I was like excited right now. So let's go. So I'm going to start with this. So last count, there were, I think, 60 people I counted in this room, 200,000 dentists, and about 330 million Americans. Less than 1/2% can actually say that they live their life stress-free of money. Less than 1/2%. Here's the truth. Less than 1/2% of those people actually have enough in income, assets, and resources to be able to withstand the effects of a lawsuit, a health issue, a real estate or stock market crash, or a government shutdown. That's the good news. The bad news is that for the first time that I've seen in 12 years, I'm starting to see practice owners lose faith that they actually can win the financial money game. And I totally get it. I totally get it. So the first thing that I'm going to teach you today, and I'm going to have to talk fast because of the time frame, is that if you haven't noticed, we do live in a legacy financial system that was not built for your success. It was not built for your success. We have a monetary system that dilutes the value of money. We have a tax system that not 1 in 30,000 people can understand, and you end up overpaying $15,000 to $20,000 in taxes. We have a legal system that for $150 you can sue anybody for anything at all. We have a debt and credit system that begs you to burden yourself with obligation. And we have an education system that, quite frankly, does not teach people the business and the financial skills that they actually need to win the money game. So I say that because if you're going to win, you better have a plan of what to do. You have to be totally prepared. The second thing I'm going to teach you is this. If you own your practice, you need to make sure you're treating it as an investment and not just a job. But most importantly, you got to make sure that you're treating your household like a business. Your household is a parent company for most of you. It owns everything that you own. Your household does. So everything you should be doing is for the benefit of the household. It's the first thing that I learned as a financial advisor. Very first thing that I learned, that if I was going to help you with your personal finances, I had to know something about your biggest investment, which is your practice. Your practice is by far your biggest investment. But over the course of your practice journey, there's hundreds of thousands of dollars that gets lost because of money that should be going to your household that gets lost for a myriad of reasons that I'll cover today. So make sure that you are running your household like a business, and there's various things you can do to do that. Now, the last thing that I want to make sure that we cover is I want to make sure that you know this, and Travis touched on this. Heed financial advice and be wary of where you get your financial advice. I have 50 people in here. All of them are in different financial conditions. All of you are in different phases of your financial journey, every one of you. And financial advice for you may not be appropriate as financial advice for you. So beware of the cookie cutter financial advice that you get out there. But most importantly, forget about just the tactics, okay? Forget about just financial tactics of what you see on TV and what you hear on TV. So look, I am a financial advisor. You'll be happy to know I'm not here to sell you an insurance or annuity or a managed account today. I am here to give you what we think is the necessary strategy that you can all utilize to make sure that you win the financial game. And with that, I'm going to go ahead and get into what we talk about now. As far as, my role, look, I've had 20,000 conversations with practice owners over the last 12 years. That we decided early on that I wanted to work with people who I felt were in control of their financial destiny. And if you own your business, if you own your practice, you are in control. And since that point in time, that's all we've been doing, is working only with practice owners on their personal finances. Now, when it comes to your practice value, because I do want to make sure that we focus on that. Your practice value is really important because, again, it is the biggest investment that most of you have. And I'm going to assume that it's the primary source of your household income for most of you. Is that a true statement? Your practice is the primary source of your income for your household. Okay, great. So you want to make sure that you're utilizing it, but most importantly, whenever you decide to transition out of that practice, and all of us are going to have to transition out at some point in time, are you going to get maximum value for that? So when I start talking with practice owners about the value of their business, the first thing I have to make sure they understand is, what roles are you playing in your business? Okay. And do you know your roles in that business? And let me explain a little bit further. So when we look at the roles that you play in your business, of course, you have the practitioner, the executive, and the owner role. Now, most of you are very comfortable with the practitioner role. That's where you went to school to learn your service and trade, okay, to be able to deliver what you deliver to your patients. And it's the most important role that you have, because if you stink at your job, nobody's going to show up. Okay, so you have to be good as a practitioner. You have to be a top-notch practitioner. That is your first responsibility to your business. But if you want to have a business that can actually function, expand, and be profitable, you have to make sure that you have an executive mindset, or hire someone that can do that for you if you don't want to play that role. Okay, and the executive, of course, is the person in the organization or the team in the organization that actually coordinates people and gets other people to get work done. That's all an executive does. It gets other people to get work done. But it's an important role for you to expand, because you can't expand on chaos. I know we sometimes try. But the role that I think a lot of you that own your business forget about was that owner role. How many of you remember the day that you decided that you were going to start your practice? You remember that day? Really? It was a glorious day one day where you made that faithful decision that I want to do this. And okay, there's a number of reasons why you did it, but mostly it was probably because you just didn't want to be told what to do anymore. That's usually what ends up happening. That's okay. But the owner is there to make sure that they give guidance to the organization. The owner is there to make sure that they give that entrepreneurial push, that purpose. That's what an owner does. They set the vision and the culture of the organization. Now, the thing with this, though, is that there is exchange that you should be getting for that in your practice. Now, I know enough practice owners that most of you are probably taxed as an S Corp of some kind, set up as an LLC, taxed as an S Corp, and you can pay yourself either in a salary and or profit distributions or owner draws. That's probably how 95% of you are set up, okay? That being said, you have to make sure that you are getting paid for all of those functions that you do in the business, okay? As a practitioner, most of you get paid for delivering your quality of service, and you get a salary. Great, that comes out of your W-2s. That should be enough to pay for your basic lifestyle. As an executive, though, if you are there creating and managing a team, then you're going to be able to get company profit of some kind. Okay, and if you have good executives in your business, good office managers, good team leaders, then you should see an increase in company profit. But where I see most of you that don't pay yourself correctly is as an owner. You don't pay yourself as an owner. And when I say that, I mean, you as an owner are taking an incredible amount of risk. And I'll say this, You all went to school for a number of years, okay? But in your business, if a regulatory agency comes in and knocks on the door, who are they going to come after? Your staff? No, they're going to come after you, okay? If you don't pay your note payment on your building or your equipment, who is the creditors going to come after? They're going to come after you, okay? If there's a rogue employee that sues you for some reason, who are they going to come after? They're going to come after you, all right? There is a risk premium that you need to make sure that you are paying who? Your household, okay? For the risk that you took to put that practice there. And I'll show you exactly how to do that. But that's an area that most people are not paying themselves as they should. But also as the owner, there should be an incredible amount of enterprise value for you at some point in time when you sell the business. If you're doing a good job as an owner, that's what an owner does, okay? He makes sure that whatever investment that they have, they're going to get maximum value for that, okay? So just make sure that you compensate yourself accordingly for the roles that you play. Now, you can try to play all three of those roles in the business. My advice to you would be to pick two. If you like to practice and you want to do that, then just be an owner practitioner. Okay. If you want to be and hire good executives, if you want to just be like an owner and you're really good at like the business side, the executive side, then be an owner executive and then hire associates. I think that will allow you to expand and give you a lot more business value for that. Now, why do I harp on this right here? Well, it's pretty simple because I've seen what happens when you deal with a not well-managed, a well-managed, and a very well-managed practice in terms of the value of the business. So I'm going to give you three different scenarios here so you can see why this is so important to you, okay? So I'm going to show you a $1.5 million business that has a 15% profit margin, a 25% profit margin, and a 30% profit margin, okay? And you'll see the difference in the overall value of that business and what that would equate to the household. So obviously a not well-managed practice, 15% profit margin, doing $225,000 a year of net income. So that's the net is at the bottom of the profit and loss statement that shows you how much that you made after taxes and everything else. That likely is not going to sell or transition for more than 2 to 3 multiple of its earnings. Why? Just too much risk there. If I'm going to come buy your practice and that's the only amount of profit that I see, it's just too much risk for me as a buyer to want to give you a lot of money for that. You see that? I mean, like I wouldn't want to pay a lot if I have to go in and fix all these things. So I'm not going to give you a huge multiple for that. If I see a well-managed practice at a 25% profit margin, $375,000, okay, now you may see the multiples go up to a bit, maybe to 4 to 5 multiple, all right? And you can see the difference in value. Now you're talking about a $1.5 to a $1.8 million practice. That sounds a lot better to me. And then you go into the very well-managed practice. Okay, this is all the things that Travis was talking about earlier. And that's a 30% profit margin. Number one, there's $450,000 there of profit for the household, and the multiples likely would go up to maybe a 5.5 to a 6.5 multiple. And then you can see what happens to the value of that business. Now it's worth 2.5 to 2.9 million. So the price that you pay for not having a well-managed practice could be $2 to $2.5 million of lost value for the benefit of your household. Okay. So that's why we put the necessity on making sure that you understand your roles in your business and you treat it like an investment and not just a job. Okay. So now a lot of you are like, my gosh, Eric, I thought you were a financial advisor. I thought you were going to talk about mutual funds and the stock market and inflation and all that stuff. I could, but that's really not what you guys need. All right. You need to make sure that you focus on your primary investment, your biggest investment, which is the practice. How do you increase the value of the practice? So really there are, I would say, 5 different things that you have to look at. Number one, making sure that you have organized personnel. So organized personnel means people know what they're doing. they have a job description, they have a statistic of what they're supposed to do so you can measure that. So everyone in your organization should have a stat, a measurement of what they're doing so someone can manage it. Stable practice systems, I'm sure they'll talk about that. Just making sure that you have systems in place of what to do for certain areas of the business. Viable income growth. Nobody is going to want to buy a practice that is going sideways or down. Nobody. So, or they will, they're going to try to give you a lot less for it. So make sure that if you want to have something that's of value, that it's always going up. Valuable property assets. When's the last time you looked at your operating agreements? When's the last time you looked at all of your registrations for your corporations and your equipment and the facility leases and all that? Make sure that all of that is in tip-top shape. So, and I know that you guys are thinking, well, I'm not going to sell, Eric. I don't care when you're going to sell. You always want to make sure that your practice is in top-notch value, regardless of where you are in your ownership phase. All this will lead to financial solvency. It will lead to you guys having a lot more money in your bank accounts for you to take advantage of. Okay, so now I'm going to go through, and if you don't listen to anything else I say.
Eric, we have one question from the audience.
Yes.
Dr. Shobha Wishwanath asks, is it typical that net income be used for valuation, or would it be EBITDA? Thank you.
Yeah. So, I mean, the EBITDA is going to be the typical methodology that they use for evaluation. And it will usually consist of, depending on who's buying your practice, it's going to consist of, if a corporate's buying your practice, they may back out some of your associate salary. If you have an associate that's going to buy you, you may want to add that back in, but they'll come up with this formula that usually includes all the expenses that you run through the business that you guys get a benefit for personally, or should be. Okay. And they'll get some kind of an adjusted number. And that's usually what the valuation of the practice will be based upon. So they're kind of interchangeable to a degree, but your EBITDA number is going to be that fancy accounting term that you guys have all heard that will tell you, how much benefit you're getting from the practice, personally. Okay, so this is important. There are only 2 golden rules that you have to understand when it comes to business and your finances, okay? And I've tried to fight this over the years, but it's just impossible for me to ignore. And that's this: 2 golden rules of income and expenses. You fight these at your peril, okay? Or you can utilize them for your benefit. First golden rule is this: your practice, your household, a country will try to spend every living dollar that it makes and then some, okay? So a business, your practice will try to spend everything that it makes and then some, okay? That's the bad news. The good news is that it will also make exactly what it thinks it needs to make to survive. I want you guys to think about this in practice. When have you ever been faced with a dilemma where you're like, oh my God, we have to come up with the money to make payroll. Oh my God, we have to come up with the money to do this, to send, the kids to this recital or whatever it would be. What ended up happening? The necessity was there for you to make the money. Okay. You guys aren't lacking anything else besides necessity. And that's what we try to build into practice owners, is building that necessity, because necessity is what's going to drive the income. I know it sounds weird, but it's exactly what happens. Okay. And you have to make sure that you are expensing your profits. Okay. Because they will not just show up at the end of the month. You have to make sure that they are expensed. This is true for your household. This is true for a country. It's true for anything. These 2 golden rules. So I'm going to show you how to apply these. Now, first and foremost, and I know Travis had talked about this, but all of you should really understand what your biggest expense is in your business. What do you guys think your biggest expense is in your business? Tell me. Staff, taxes, overhead, or what else? No, mortgage payments, whatever it would be. Okay. None of those are your biggest expense. None of them are. Here's your biggest expense. Your biggest expense is money that you should have made, but you didn't. That's your biggest expense, okay? So what do I mean by that? So all of you have a facility, 2,000 square feet, 3,000 square foot, 5,000 square foot, 1,000 square foot, whatever it is, okay? You all have chairs and, exam rooms and whatever, and x-rays, everything, okay? You have staff, all of that. What if that facility were at optimum, if it were running at optimum, just like Travis was talking about earlier, what could it do? What is the facility capacity number that it could do? Now, I've asked 1 in 10 dentists that same question every time I meet them. What's your facility capacity goal? And most of them have zero idea what that number is. And I'm like, how can you not know that number? That's what you're trying to get to. That's what the practice needs to get to for you to get optimum value out of this thing. Okay. So however you guys want to calculate it, we usually look at, okay, how many patients can you see a day? What's the average transaction that keeps you profitable? What's the daily income potential? How many days in a month? That'll tell you, what your facility, I'm sure there's a number of ways to do it that from guys that are smarter than me in this area. But just know that that's the number one thing that I would figure out in your practice is what is my facility capacity number? Because what you're doing right now and what you could do is your biggest expense. That's lost income that you guys could be making and aren't, okay? And that can go to a lot of fun things, for the benefit of your household. The other number that I want to make sure that you understand, that you guys work out and don't underestimate, is what we call your make-break number. Now, what do I mean your make-break number? How many of you have a make-break number in your organization, in your business, that you think you know? Okay. I will say that probably 90% of you are underestimating what that make-break number actually needs to be. What do I mean by that? Because when I ask people their make-break number, typically I'm going to get this. I'm going to say, well, my rent, my payroll, my mortgage, cost of goods sold, and everything else, marketing, maybe a little bit in business savings, and I take out just enough to pay for my lifestyle. That's typically what I do. And remember the golden rules, right? The business will make exactly what it thinks it needs to make to survive. That is what that business thinks it needs to make to survive. Okay. And they think that their make break is $100,000, and that's exactly how much they make. Okay. But they are missing a number of expenses. And the most important expense, of course, are the 4 things that I have up here, which I think every one of you should be channeling money towards. Okay. First and foremost is that owner compensation. Okay. That 10% that we call your owner compensation. All right. All of you should have a system set up where 10% of your practice revenue goes into an account. Okay. We have a special fancy name for it, and I'll tell you in a second, that is designed for you to then create other income sources outside of your practice. Because do you want to be reliant upon your practice income for your household financial survival for the rest of your life? No. You want to have other income sources. So the way to cut, but I don't want that to take 25 years to do, or 15. You should be able to do this in like 7 to 10. Okay. But to be able to do that, you have to take 10% of your practice revenue and channel that, expense it out for the benefit of the household. Same thing with your taxes. You are personally liable for the profit of the business for most of you from a tax standpoint. So you got to make sure that money is being set aside for taxes. You should have at least 2 months of business savings so that if there's an emergency or if you get shut down for 6 weeks, you guys can function without depending upon the government to save us. And then you should have a business and expansion and development fund. Okay. Now, as I'm going through this, you're like, Eric, there's no way I can take 10% of my practice revenue out right now. You're crazy. I know I am. But here's the thing. your make-break number is wrong. Your make-break number is wrong. Because if I go in there and I say, what is your actual make-break number? It should be 125,000. The practice will make exactly what it thinks it needs to make to survive. And when you put in these things as actual expenses, what will happen is that the business will start to make it to cover it. Okay, it will make it to cover it. So I promise you this works. It's not some fancy, witch doctor, magic that I do. It's just you put these things in, and over time, it actually does create, the business does create the money to be able to cover it. And yeah, it's going to force you to, like Travis said, that was great, to move a little faster. Okay, to get your staff to move a little faster, to push a little harder. Okay, but it's not like I'm asking to go 100% more or 10x. I just need you to do like 5% more, or a staff member to do 5% more. It will make a difference in this. But can you imagine what your life would look like if you had money to pay your taxes, if you were doing 10% into a wealth storage account as profit for yourself, and we're still able to take enough money out to pay for your basic lifestyle, right? Your life could look totally different than what it does. I will say this, because I know we're probably running a little bit short on time, but make sure that you guys stop by the booth. I have a free book, a financial success guide for private practice dentists, and I better keep going because I haven't talked fast enough. Now, I do want to make sure you guys understand the strategy, though, that I'm talking about. For most of you, what you've been told, and I'm probably just going to have to go straight to it, is that, well, if I just save a portion of my income and put it in retirement plan accounts, then I should, as long as I save enough to replace 70 to 80% of my current income, I should be okay. Okay, that's what most financial advisors will tell you to do. Okay, put money into passive index funds. Okay, and just hope that in the next 20 to 30 years, I'll have enough to replace 70 to 80% of my income. Okay, you can do that. I'm not saying it's totally bad. I mean, it's better than doing nothing. But what I think most of you should do is look at this. Number one, your household is the parent company, as you can see right there. And your business should be able to take enough out in salary and profit distributions that can pay for your lifestyle, your taxes, and your debt. If you look at what the practice can provide. And if you own your practice building, it's an incredible asset to own. So if you guys can get your practice buildings, definitely get them. Okay, definitely get them if you can, because that will provide a rent to the household at some point in time. And if you have qualified plans, I'm not telling you to not contribute to them. Just don't rely upon them 100% for your retirement at all. Okay. But I think the thing that's missing for most people is taking that 10%, expensing it out, and you put it into a household wealth storage account. Now, you're going to go back and you're going to ask your advisors or your accountants, hey, I need one of those wealth storage accounts. This guy talked about this wealth storage account, and they're going to be like, there's no such thing. It's just a bank account where you set up an automatic and systematic payment from the business checking account into that account that then is used to deploy into other investments. And whether you're a stock market guy, whether you're an insurance person, or whether you're a real estate person, I don't care. I love all three. I think you should do all three for very different reasons, okay? But at the end of the day, there should be enough money going in there where you're going to be able to have 1, 2, 3, 4, 5, 6 different income sources for the benefit of the household. Okay. That's a strategy. Okay. I didn't mention Bitcoin or crypto. I didn't mention, all these other things that you can do. Okay. I don't mind if you want to speculate, but this is your strategy to protect your household from inflation, from anything. Okay. Is to be able to create multiple income streams using your practice to be able to do that. Okay. Now, I will say that most of you if you own your business and your real estate, please recognize that it is a risky endeavor. So as much as you want to try to go speculate in other areas, I would caution you that you're already speculating quite a bit in owning a business and owning the real estate. So just make sure that you don't put all of your investment reserves at risk at the same time, over speculating in like just an individual stock or, you know, something like that. Okay, I know some of the other guys are going to talk about taxes, and I can't wait to hear them because I think that they're going to get more detailed. I'll just say this about taxes. If you think that your tax bill is going to go down all by itself, it won't. Okay, if you are passive when it comes to taxes, then you are going to end up paying the most out of anybody. You cannot be passive. All right, you have to be active. You have to be it takes willingness, energy, effort, follow through, and documentation. If you are getting from your accountant that, hey, just buy equipment and put all your money in a 401k plan as your tax strategy by the end of the year, then you have a lazy tax planning. Okay, so just make sure that you are getting a second opinion, and then learn about some non-mainstream strategies. And I think some of the guys will probably talk about that. Some really good strategies that all of you can take advantage of that are legal, that will help you with your tax planning. Okay, so I've talked really, really fast. I think I've pounded a lot at you guys in like 17.
There was a question from the audience.
Yeah.
Some people in the audience were asking if they could get a copy of the book and a copy of your presentation. I told them that if they email DocOff Assist and they entitle it Econologics, that we'll get those forwarded to you to get them either an e-copy of the book, or we'll arrange something afterwards.
They can definitely just go to the booth and get the book. So
for the virtual attendees.
We have, definitely. We'll figure out a solution for that.
All right, perfect. You heard it, guys.
Yep. Okay, good. So look, I want to talk to you about your team, because all of you need to build a financial team. And whether it's a good CPA, if you have an insurance agent, an attorney, a wealth manager, I think all of those are really, really valuable. But to me, you need someone that understands both your household and your business, especially when it comes to financial advice. So I wouldn't work with anybody other than an industry-specific advisor, someone that does have some understanding of how important your business is to your personal financial plan, okay? And I think that I've seen a world of difference in that over time, because an industry-specific advisor won't let the money that comes in and out of your practice, which is millions of dollars, get lost. Okay, they'll make sure that it channels to your household. Okay, all right, here is your game plan for the next year. All right, and I know a lot of you, when I talk about managing your household like a business, you need to make sure that that you guys are focusing on the right things. There's so many things to focus on out there. I get it. And you guys are inundated, Dennis more than anybody else, with fancy tax strategies, with fancy asset protection strategies, with fancy investments, and private placements, and all this other stuff out there. And yes, they're okay, but you need to focus on what you can do and what you can control, okay? So here's what I think you guys should be focusing on. Number one, your business at minimum should be growing at a 25% rate over a 3-year period, okay? So that means whatever you did in 2019, whatever you did in 2021, I should see a growth rate of a minimum of 25%, minimum of 25%. That tells me that you're running your business like a business and it is growing, okay? That's a good sign for someone to see. Number two, you should be expensing out 7 to 10% of your practice profits, of your practice income, all right, into a household wealth storage account for the benefit of creating other income sources outside of your practice, okay? If you have $1 million practice, that's $100,000 taken right off the top, okay? That's gonna go into a plan to create other income sources. All of you should be on track to be personally debt-free in 5 to 7 years. Student loans, houses, I know you got them big mortgages and everything, all of that should be paid off in 5 to 7 years. You should be making over $300,000 a year personal income should be your target. Your effective tax rate should be under 30%. Everyone's complaining about inflation at 7.5% when your effective tax rates are at 35%. You can control that, okay? Your passive income goal, you should have achieved a certain level of that. Profit margins of your business should at least be 20% or higher. 2 months of business expenses in your business. So you have reserves of at least 2 months of expenses. You should be following some kind of a plan and then doing some kind of financial training like you're doing right now. Okay, that's good. Those are things I think, can you imagine what your life would look like if all those things were in play? It would look a heck of a lot different than it does right now. And you have control over almost all of those things. You have control over the outcome, okay? You don't have to worry about the price of oil, you know, or what the S&P 500 did today. You don't have to worry about any of that if you focus on that. Most of you think that the external factors are what is affecting your financial condition. I can tell you 99% of it is an inside job, right? In your business and your household, that you guys all have control over that, okay? So those would be we call them our financial beast statistics, because if you get all those things in play, you are a financial beast, or you're on your way to it. Okay, so last thing, I'll make this offer. If you guys want to meet with me for 15 to 30 minutes, you can just come over to the booth, let a team member know. We'll give you the book, and we'll extend the same thing to the people that are online, that if you want to do like a 15 to 30 minute consultation, you guys can ask me anything that you want to, okay? I'm not going to try to sell you on anything. You can ask me any financial question, please, that you want to, in terms of, you know, debt, taxes, estate planning, asset protection. We've got asset protection guys here, so they probably know a little bit better than I do. But anything that is financially related, we'll make that offer of 15 to 30 minutes. So, whew, I got through 20 slides in like 32 minutes. I thought that was pretty good. So any questions that anybody has? I know I probably threw like a whole day seminar at you guys in 30 minutes, but I hope you got something out of it. Yes.
If I were to hire you, do it on how do you set that up?
Yeah, so we do financial planning. So the first thing we do is we create a plan for that owner. So there's a fee associated with that we charge to be able to do that. And then our model is a little different. I don't think that your money takes time off. And most of the financial advice models out there, or maybe you meet once or twice with your advisor to go over a portfolio review or something like that. We like to do it at least on a monthly basis. So we have an ongoing advisory fee that we usually charge to be able to do that. And yeah, we do insurance and investments and those kinds of things as well. But we set up a plan first that can get executed. So we get all these things set in motion, so that, you at least have, some idea that these things are being taken care of.
Eric, we have a question from the audience.
Yes.
Do you have any relevant advice for associates on how to save money on taxes?
On taxes, no. Well, I'm sure. Yeah. Okay. So as far as associates are concerned, here's what I would do. I would probably, whatever you make, I would probably take about 30 to 40, that 10% of the practice revenue that I tell you to save. If you're an associate, I'd save about 30 to 40% of my income. Okay. That's about what I would do for that. So it's a lot. I know, it's like, wow, that's a big amount, but we're trying to get people in the habit of protecting themselves. Yes. Yeah. Same for everybody. Yep. It's the same for everybody. But that's what I would probably do as an associate. And, as an associate, look, you're probably relegated a little bit to not a lot of advanced tax strategies, because a lot of the advanced tax strategies for business owners, and that's the benefit of having a business, is that you can do that. But, there's HSA accounts that you can put money into, of course, your traditional qualified plans, and maybe starting a side business that you guys can run some expenses through as well would be something that you can do. Yep. Really? Yes.
Interest rates being at historic lows, they're looking at increasing in the near future. A lot of people talking about taking out more debt to be able to leverage your position. Well, I think you mentioned about trying to get debt in 3 to 5 to 7 years.
Yep.
What's your thoughts about building well, obviously leverage?
Yep. There's two types of debt. You got consumption debt and productive debt. Okay. Not all debt is bad. So if I'm going to borrow money, I'm definitely going to make sure that when I borrow money, it's going to do 3 things for me. Number 1, I'm going to get a tax benefit for it. Number 2, the asset should appreciate in value, and it should create income for me. If it doesn't do those 3 things, then I'm not going to borrow money for it. Okay. Or whatever I did borrow money for, I'm going to try to pay it off as fast as I can. So with interest rates being low, you know, there's an opportunity here to buy practices, to buy real estate, to do that. Absolutely. There is good debt, and there's, you know, good and bad's kind of like, there's productive debt, and then there's just there's destructive debt. I like productive debt because I think that's beneficial for sure. Yep. Any other questions? So the debt, if you're going to borrow money for whatever reason, and this is my argument for the house not being an investment, but it should create income for you. It should appreciate in value, which means that the value of it goes up as opposed to going down. And if it can give you a tax benefit, that's beneficial. So when you buy a building or real estate or something like that, that's why that's good debt. Okay, when you just buy fancy cars, you know, vacations, credit cards, that's bad debt. So that I would pay off as fast as I can. 15 to 30 minutes, guys. I know I covered a lot. Hopefully that was helpful to you. And I appreciate your time, and we'll be back at our booth to talk later. Okay, thanks.